Home affordability is a major issue in today's real estate market, and many home buyers are looking for ways to reduce their monthly payments now until interest rates drop later. One of the most common ways of doing that is with interest rate buydowns that can result in significantly lower payments in the short term. So let's discuss how interest rates are determined, how they affect your monthly housing payment, how rate buydowns can make a home more affordable, what discount points are and how they differ from a buydown, and how to determine which of those options will be best for you. So interest rates are determined by multiple things. The first is the type of loan you're actually getting. Now, we know there are different types of mortgages if you watch my other videos. There are conventional mortgages, FHA mortgages, jumbo mortgages, VA mortgages. All of those come with different interest rate types and different reasons why those rates can differ. Your down payment is another reason why your interest rate can be different on the same type of loan. Less money down can actually give you a lower rate than more money down, depending on that difference. Once you hit that 25% down mark, the rates tend to be a little bit better, but anything between 3% as a first-time buyer and 24.9% is really going to result in a lower interest rate than that of more money down. Now, credit score, huge factor depending on the loan type. Your credit score plays a significant part in determining what your interest rate is. Some loans, like FHA, are less strict on the credit score, meaning they put less emphasis on that score and how it affects the interest rate. While conventional mortgages, on the other hand, are heavily affected by your credit score. So we know the minimum credit score on a conventional loan is 620, but that's the minimum. And at the minimum, you're going to have a much higher interest rate than if you were at the maximum or highest tier for credit of 780 or above on a conventional mortgage. The type of property you're buying, whether it's a single family home, a condo, a townhome, a multifamily like a 2-unit, 3-unit, or 4-unit property, will have an impact on the interest rate. The way you plan to occupy or not occupy the property is going to play a part in determining your interest rate. If you're buying a primary home using a conventional mortgage, your rate is going to be much better than if you were buying a second home or investment property also using a conventional mortgage. The rate on a second home or investment property is going to be much, much higher than that of a primary residence on a conventional loan. Now, how do interest rates actually affect your monthly payments? Well, that's pretty simple. A higher rate is going to equal a higher payment. So for example, if you had a $500,000 loan in 2021 with a 3% rate, and we're going to compare that to a $500,000 loan now in 2024 at a 7% rate, there's a substantial difference. The principal and interest at 3% on that loan is $2,108 per month, which actually equals $758,880 over 30 years. However, in today's market, the principal and interest payment on that same $500,000 at 7% equals $3,326 per month, which would be $1,197,360 over 30 years. So that's substantial. That's $400,000 more on the same loan amount just because the rate is higher. So the rate obviously has a substantial impact on the monthly payments. Now, the payment is obviously higher, which is going to equal a higher debt to income ratio, making it more difficult to qualify for a property. So someone that might have qualified to buy a $500,000 property when rates were at 3%, if they were at the cusp of what they qualify for, meaning the max based on their debt to income ratio, the amount of money they make monthly versus what their expenditures are monthly on their credit report plus the new housing payment, if that was capped when they were at 3%, allowing them to go to $500,000, well, clearly rates now being at 7%, if their income has not increased or their debts have not decreased, well, they're not going to qualify for that $500,000 anymore. Now, how can we use temporary rate buydowns to make a home more affordable? Well, let's get into that. First off, you need to know what a temporary rate buydown is. A temporary rate buydown is a shortened period of time for which you have a reduced interest rate. For example, you can have a 2-1 temporary rate buydown. What that would mean is the first year of that mortgage has an interest rate that's 2% below whatever your actual rate is. So if your rate is 7%, you'd be at 5% the first year. The 1 in 2-1 represents the reduction in the rate for the second year of that mortgage. So it's a 1% reduction from the 7% that second year. So if you're at 7 normally, you'd be at 6% that second year. What it's going to do though is it's actually going to give you a lower monthly payment, right? Lower payment's going to make you have a more affordable payment on that property, obviously make the property more affordable for you, but you still need to qualify for the payment based on the 7% interest rate. Now, what's cool about temporary rate buy downs and what really makes them effective is the seller can pay for them. Now, it doesn't really make financial sense for you to pay for your own temporary rate buy down. And the reason I say that is because the cost of the temporary buy down is actually equal to the savings from that temporary buy down. So if you paid $12,000, for example, to do a 2-1 buy down, you're saving $12,000. So if it's costing you $12,000 to save $12,000, well, you're not actually saving anything, right? It's a wash. You're just making it feel like you saved something because your payment's lower in the short term, but it was your own money that got your payment there. So the benefit's not really the same as if you got a seller credit, meaning a concession or something from the seller that paid for that in full on your behalf. So the money's actually coming out. Then you haven't paid anything, and all of the money that you're saving is true savings. And what's cool about temporary buy downs on top of all that is any unused portion of that buy down, let's say it was $12,000, that's still available if you decide to refinance or sell the property before that 2-year window in the example of the 2-1 buy down. Before that period has lapsed, any unused portion still belongs to you. So let's just say you refinance and you're only 12 months into your mortgage. That means there's still a good amount of money left over from the initial $12,000 that was paid by the seller for your temporary buy down. That would actually be given back to you when you refinance. It can be used to pay closing costs on your refinance or reduce the principal balance, meaning the balance of your mortgage at that time. So that's something that's really, really cool about temporary rate buy downs. Let me give you an example of how much money a temporary rate buy down can actually save you on a monthly basis and what the difference would be versus the actual regular interest rate. So let's just say you did 2-1 buy down on a $500,000 loan. You knew you were going to be getting a 7% rate. Let's just say that was the market rate. And we want to say, how much money will this save me in the first year of ownership if I have a 2-1 buy down? So my rate's being reduced by 2%, which would mean 5% that first year. Well, to see the savings, you want to know, well, one, at 7%, my principal and interest payment is $3,326.51 per month. At 5%, my principal and interest payment is $2,684.11 per month. That's over a $300 per month savings in your monthly payment. That could be a lot easier for you to segue out of renting into buying if it's maybe closer to what you're paying in rent and you want to have a little reprieve for your first year of home ownership and kind of get acclimated to owning that property, because maybe you know you're going to have other expenses that you're going to incur within that first year. Maybe it's buying furniture, whatever the case may be. And you want to know, at least for that first year of ownership, you're going to have a little bit easier time easing into it. This is a great way to do that. And the cost of the buy down in that example would be $11,654. And like I said before, that's equivalent to your savings over the first 2 years. So you paying for your own temporary rate buy down really does not make sense. However, if you can have a seller credit negotiated into your contract, it's something your realtor would do for you at the time that you submit an offer on a property. If that can be negotiated for you, I recommend utilizing it toward a temporary rate buy down to make your payments more affordable. Now, let's talk about discount points, because discount points are often confused with rate buy downs, and they're not the same thing. Rate buy downs, we just explained what those are. Discount points, on the other hand, are upfront costs that are used to buy your interest rate down. So it is buying it down, but it's for the life of the loan. One discount point equals 1% of your loan amount. So if your loan amount's $500,000, one discount point would be $5,000. It's 1% of $500,000. That's paid as part of your closing costs. Once again, it could be paid by the seller, but it's used to buy your rate down for the entire length of the mortgage. So not just the first year or two. If you pay one discount point to reduce your interest rate, it typically reduces it by 0.25%. Your rate's reduced for all 30 years. If it's a 30-year mortgage, by that 0.25%, you're going to have a lower payment, but your rate remains lower for the entire time that you have that mortgage. Now, the benefit and the reason you would pay a discount point to buy your rate down permanently rather than using money toward a temporary rate buy down, which only reduces your interest rate in the short term, although it's going to reduce it by more than what you get with the discount point, it's actually going to not benefit you in qualifying. So the benefit of discount points, on top of it reducing the rate and so forth, is the reduced rate, because it's permanent, makes it easier for you to qualify for the property. So by reducing that rate by 0.25%, it could result in a payment that's a couple $100, $150, $200 less than what it would have been at the rate you qualify for without paying the point. And because of that, it could be the difference of qualifying for a property versus not qualifying for a property. With a buy down, a temporary rate buy down, you're still qualifying off the higher interest rate. So we'll call it the 7%. You're not qualifying qualifying off the 5% or the 6%. But in the case of the discount point, you're qualifying for the mortgage based on the now lower rate. So for example, let's just say that you're doing a $500,000 loan at 7% versus a $500,000 loan, and maybe in today's market, one discount point saves you 0.5%. So it gets you down to 6.5% on the interest rate. Well, at 7%, like we said before, the principal and interest payment's $3,326.51. At 6.5% on the same 500,000, your payment's $3,160.34, which is a difference of just over $166 per month. And that difference of $166 per month could be the difference between you qualifying and not qualifying for a property. Assuming your income is $7,000 per month and your debt to income ratio, meaning what you make monthly versus what you spend monthly, including the property, is at 47% at a 7% rate. Well, paying a discount point of $5,000 to reduce your rate to 6.5%, the payment's actually being reduced enough that it would drop your debt to income ratio to 45%, which is typically the percentage needed to qualify for a conventional loan. So you see, it actually was the difference between qualifying and not qualifying for that property. And this is because that $166 in this example is equal to just over 2% of your monthly income. And that's why it was able to reduce you down to a qualifying level. So that's how discount points work and why they operate differently than short-term temporary rate buydowns, right? Discount points can help you qualify for more. Temporary rate buydowns give you a lower payment, but do not help you qualify for more. Now, how do you determine which option or options are best for you? Well, you have to ask yourself some important questions. So one is, how long do you plan on keeping the property? The shorter amount of time you plan to keep the property, the less it makes sense for you to pay discount points, unless, like I said, they're needed to qualify for the property. But if you just want a lower rate because you want to be able to tell your friends you have a lower rate on your property, I mean, no one knows what your rate is unless you tell them, right? But if you're just trying to do that because you want to be able to brag, but you only plan to keep your property a couple years, well, it may not make sense to pay discount points. And that's because, let's just say it's $5,000 in the example we just talked about to buy the discount point. It's saving you $166 a month. That's roughly $1,900 a year that you're saving by paying $5,000. Well, to determine how long you need to keep the property to break even on the money you're spending is you need to divide that $1,900 into that $5,000. Let's make the math even easier. Let's just call it's $2,000. Cost you $2,000, or saving you $2,000 per year, and it's costing you $5,000. That means it would take you 2.5 years to break even, right? 2,000 into 5,000 is 2.5. That's how long you have to keep the home or mortgage to really benefit from paying the discount point. So how long you plan to keep the property or how long you plan to keep the mortgage is an extremely important question you need to ask yourself. And when I say how long you plan to keep the mortgage is, do you plan to refinance when rates eventually drop, right? Maybe you're not gonna be in a position to pay your mortgage off in the short term, but when you refinance to a lower interest rate, your mortgage is being paid off. So any discount points you would have paid to have a lower interest rate, if you didn't need the lower rate to qualify, any of that money you would have paid up front, you're going to lose if, in this example, if you refinance after 12 months, because you still have another year and a half that it would have taken to recoup that upfront cost. You would have been better off taking the 7% you qualified for, closing, not paying the upfront cost, and maybe applying that extra cost when you refinance to get an even lower interest rate than what might be available when market rates drop, right? Like I said, if you don't need to pay the points to qualify for the property, then you want to avoid paying the discount points. So make sure you ask yourself those questions. You also want to say, does a temporary buy down give you a monthly payment you're more comfortable with, right? Let's talk about the temporary rate buy down again. Maybe a temporary rate buy down gets your payment to a point where you're comfortable buying now rather than waiting till rates drop to buy, right? You might be on the fence. You might say, hey, I think rates are too high right now, and the resulting payment, because rates are high, in my opinion, is going to be more than I feel I'm comfortable paying, more than I can afford. Although maybe I qualify for the mortgage, I'm not 100% certain I want to move forward with that. Well, a temporary rate buy down might be able to get that payment down to where you're comfortable and get you off the fence, stop renting, buy now. And like I said before, you can always refinance. You'll get the portion of the unused funds from that temporary rate buy down back when you refinance. But those are things you want to ask yourself, right? Those are things that really make a difference in whether you're going to buy now or buy later, and which of the options, if any, are going to make sense. Now, at least one of these options is going to make sense to you. I've never met a person who doesn't want a lower interest rate or lower payment. So naturally, one of these will make sense. In this market where you can actually still negotiate credits from sellers, it's the best time to take advantage of a temporary rate buy down or any sort of rate reduction that can be covered by the seller. So make sure you do so. Now that you have a better understanding of rates and ways to reduce them, I hope you have more confidence in becoming a homeowner. If you have any questions about your specific scenario, please leave a comment below. I reply to 100% of the comments left on my videos, and make sure to subscribe if you'd like to continue educating yourself on all things mortgage and real estate related.